Preparing to start meeting. Welcome everybody to this gold market update. If you just bear with us as we get ourselves sorted out here. What we're trying to do at this moment in time is to keep everybody, all of our community, up to date with exactly what's going on in the precious metals market. And I'm joined today, as usual, by Marco Byrne and Stephen Flood from Goldcore. Now, what we're going to do is we're just going to be very briefly in about 10 minutes. We're going to pick out about 3 things that we've seen and that have caught our eye over the last 24 hours that are going to give us a bit of a flavor, a little bit of a steer on what's happening, both in precious metals and also in the wider markets, the wider financial markets. And we've titled this Economics Turned on Its Head, because these are strange times that we are living through at the moment. They're unprecedented times, unprecedented risks. There's a lot going on out there and there's a lot of confusion. So hopefully what we're going to try and do is to unwind a little bit of that confusion, give you our opinions on exactly what direction that the market is or may be going, or exactly what's going on at this moment in time. And Mark, I'll probably come to you first. This is what you said has caught your eye now over the last 24 hours, which is a headline from the Wall Street Journal. Maybe you might talk to this for a few minutes.
Yeah, so we're seeing globally just absolutely huge demand for physical coins and bars. And the supply simply isn't there. We've long covered how the gold market, and even more so the silver market, they're very, very small markets in terms of the above ground refined available stocks of coins and bars and investment grade gold and silver. So all it takes is a significant uptick in safe haven demand, and you see supply issues. And we saw that during when Lehman Brothers went bust, and we saw during the debt crisis from 2009 through to 2011, 12, those ebbs and flows. But there were periods during that time when we couldn't actually get the stock of even the large gold bars and silver bars. So the same thing is happening again now, but even an even bigger way. It's funny, a lot of it is being blamed on the coronavirus, and the coronavirus, there's no doubt that's a factor because it is massively impacting our economies and the supply chains, including the supply chains in the precious metals industry. So that story there we see from Wall Street Journal, it's talking about a global gold push, and there is to a degree, and an epic shortage, and there is to a degree, but is being blamed on the coronavirus, and the coronavirus is said it's a factor, but it's not the sole factor that's driving it. It's more about just, yeah, it's a very, very small market, and the futures market is roughly 90 to 100 times more gold traded on futures market than there is the underlying physical assets. So it's a hugely leveraged market. In effect, it's a bit like the banking system. It's a fractional reserve gold market, and therefore all it takes is a significant demand from investors, high net worth investors, and institutional demand to basically create these shortages we're seeing, So that's what's happening. And basically, yeah, we're seeing huge demand, and that's leading to the gold price hasn't reacted as much as it should, because as we know, the futures price can wag the tail of a dog. We've seen that throughout the years, but ultimately it does lead to higher prices in the medium and long term. And what we're seeing is huge premiums. So in effect, the price discovery, the physical price for coins and bars is actually detaching away from the spot price and the futures price, because the premiums that are being paid for coins and bars are much higher, and that reflects the actual real world forces of supply demand in the marketplace. So it's very, very bullish what's happening both in the gold market and in the wider market. I think we're going to talk about that in terms of the wider world of economics and finance, which have been on their head, So people just need to take a few deep breaths. We're going to come through this health crisis. It's a worrying time for everybody, family and friends, and rest. But we will come through it, but there are going to be significant financial and indeed monetary issues that we're going to have to deal with.
Right, I suppose you're seeing pressures on both sides, because obviously there's a huge demand for physical metal at this moment in time. But at the same time, you're also seeing supply constraints, because you're seeing a few of the refineries have had to reduce or close down for a period of time. So I suppose it just shows that
some of the biggest ones.
Yeah, I suppose it shows that the production of physical coins and bars operates on this just in time, very much like most industries. So when we have this interruption to that flow, and you have now at the same time, you've got that supply constraint at the same time as you've got this massive demand for physical bars and coins, that's why we're seeing massive blowouts in premiums.
It's a perfect storm. It's a perfect storm. If you look at it, it's actually a three-way squeeze. You have low relative prices for gold and silver. Prices actually came off a bit. It sparked a lot of demand. And then you had obviously supply side, the immense refineries, reduced production drastically. And then you had an economic demand coming from COVID related issues. And it's a perfect storm. And so, yeah, stocks got depleted very quickly. We've been incredibly busy, so many people looking to hedge their bets and put a bit of money into precious metals, and it's been fascinating. It really is. And I love the title there you chose in the article, Mark, unaffordium and unobtainium, and it literally, it's not far from the truth. Unaffordium in terms of premiums have really rocketed for what dwindling supplies are left. Unobtainium because you can't buy it as easily as you could have before. So it's an incredible situation. I've never seen the like of it, and it might continue for weeks, maybe even months. It depends how COVID develops.
Yeah, absolutely. Just credit to Wall Street Journal and actually Mike Maloney, who came up with those terms, unaffordium and unobtainium, and you're absolutely, they are actually quite affordable right now if you can get your hands on it. Who knows? In a couple of months and years, I think they will become much less affordable to the masses.
We're working with we've got supply. It's just it's delivered slightly differently, and we're working with the Perth Mint and the Royal Mint and a number of other suppliers as well. So we do have some supply coming in.
Yeah. Steve, this is the story that caught your eye. Maybe just move us out of the way there for a second so our viewers can see it.
Yeah, so it's an interesting story. It may be a little bit boring at first. On first analysis, ECB may force banks to delay dividends if they don't comply. I'm a capitalist. I believe in people starting businesses, owning businesses, developing businesses. I believe in good businesses succeeding and bad businesses falling and capital getting reallocated. But what we're seeing now is this official shadow being cast over the markets, where the central banks are acting like the law in all respects, and forcing banks to stop dividend payments sounds politically very expedient and popular and makes sense for all the right reasons. But on a conceptual basis, when you tell somebody that their asset is limited in terms of what they can do with it, and they can't release capital to themselves, even if they own the company, it's concerning. And so where does this stop? Right now, this may make sense, but if they start this policy, where are we in 5, 10, 15, 20 years? I mean, are they going to suddenly tell people you own it, but only on our terms? So I find this very concerning. I think this is very big brotherish. It's Orwellian even, and it's concerning. I think if the ECB owns those banks, or the taxpayer owns those banks, then maybe they can call the shots, obviously. But as a regulator, I don't know if I'm comfortable with this at all. And in conceptual terms, I think it's quite scary.
Okay. Interesting.
I would agree. I think ultimately the end game is potentially, these banks are already very, very vulnerable, as particularly banks in Italy and Spain and Greece and periphery nations. And ultimately, if they're going to, that's a step towards, you mentioned the word nationalization, and some of these banks are quasi-nationalized already. So, and it's not just banks that are being nationalized in terms of the whole capitalist system is being bailed out, including airlines and all sorts, with all sorts of unintended consequences.
Yeah, I mean, where does it end? Is it like we've decided that your pension can only invest in, we're going to narrow your investment options to suit ourselves, and yeah, it stinks of corruption, to be honest, and people who don't really have an eye on history and don't really believe in economics and capitalism as the best way to extract value and to organize an economy and the skill sets in that economy. Sorry, Dave, go ahead.
So no, I was just going to bring it on to something that caught my eye. This is actually something that Steve, that you sent to me, just this screenshot And we've got this really incongruous juxtaposition that we've got going on here. I mean, obviously stock markets have taken an absolute hammering over the last month or so, and the Dow has fallen from its high of nearly 30,000, didn't quite get there, but just under, down to, it touched into the 18,000s. Now we've had a very strong rally there since. We've rallied over 3,000 points since then. I haven't seen how the markets have opened, but they were looking flat before we came on live here, flat to down small. But we have seen the markets react to stimulus package suggestions that maybe we come out of this at Easter, or at least that's things that have been mooted in the US. Now moving away from that now, but still we're seeing an awful lot of buoyancy in this stock market. Is it a dead cat bounce? I don't know, but I mean, if we look at this kind of incongruous juxtaposition here, where we're saying the coronavirus job losses could total 47 million in the US. That's an unemployment rate to hit 32%. And you have a picture there now, the New York State Labor Department, and we know how bad things are in New York as well at this moment in time. But then you look at the top of that page and you see the Dow up 3.2%, 690 points. It's rallied from its lows. I mean, my question at this moment in time is, how do you actually value a stock? What are its future cash flows at this moment in time? They are just so absolutely uncertain. We're not even at the height of this crisis. We're being told the height of the crisis is, 10 days away, 2 weeks away or more. We don't know yet what the long-term implications are. So the stock market is doing some funny things. Now, is it a case of when we come out of this, we're going to get massive amounts of money printing, massive amounts of money put into the stock markets, massive amounts of money printed, and as a result of that, we get massive hyperinflation, inflation or massive hyperinflation? I don't know. And the only place for the money to go, into the stock market, into the bond market. Who knows? Yeah. But it's just really, the incongruous juxtapositioning of these two things on that one image, on that one page, really caught my eye.
It's a fascinating time. I mean, like, I think what you have there is the signs of an 11-year bull market, where a lot of the market participants really don't have much of an institutional memory or part of, and they just know one way up, and they know that every sell-off in the past has been supported by the Fed. There's moral hazard there. They think it's going to happen again, that it's a one-way ticket, and if it falls off, it's a buyer's opportunity. And they've never really seen a bear market, a lot of them, and how absolutely awful it is. And when you get capitulation, when the market drops and keeps dropping relentlessly, and their margins are called upon, and fear and blood on the streets, and all these analogies. I think it's we're not there, not even halfway there. Would be my view, but I'm very optimistic. I think out of this, hopefully something better will come, and a more resilient workforce. People, I think this generation, it's incredible. Like, I'm 47, and this is the third major financial crisis that we've had in the last 20 years. Which is unbelievable when you think about it, the volatility that we've been exposed to, this generation. So yeah, I think it's an interesting one. Yeah, I'm not sure what you think, Mark.
No, I agree with both of you, and it's just crazy, and there's so many sort of massive contradictions like that. The Dow is actually down 22% this quarter. I was just reading there, it's on track to the worst quarter since 1987, and it's actually the worst first quarter ever. And the first quarter can be quite important, as we know. Psychology is very important, and momentum is very important as well. And the momentum has fundamentally changed. The psychology has fundamentally changed. We always tell our clients, even when gold prices come off and silver prices come off, in the short term, there's an old Wall Street expression, which is never catch a falling knife. And right now, the trend, there has been a bounce, but I think it will be seen as a dead cat bounce at time, because I think we're going to go lower again. But as you said, Dave, I mean, nobody knows, no one has a crystal ball in the medium and long term, the amount of money that's being created and the amount of bailouts. I see our old friend, Dr. Konstantin Gurdjieff, who used to be on the investment committee with Goldcore. He's an excellent economist, and he summed up all the various bailouts and put them all together, and he says 5.9 trillion has been put into markets, and electronically created in the last 2 or 3 weeks, So if they're absolutely determined to get markets higher, who knows, they may be able to get it higher. But meanwhile, the underlying value of the real economy is under pressure, and the value of the currency ultimately. So the Dow might go up next year 20-30%, but the dollar may be down 20-30%. Fiat currencies that the stock markets are denominated may go much, much lower. So bottom line is, we don't know. It may go, and the stagflation 1970s, stock markets actually went sideways for the 10 years while the economy deteriorated and gold, silver prices went through the roof. So that's a potential scenario, that's stagflation scenario, because economies are going to contract. But I think we're going to, with the supply chain issue, I think we're going to see inflation. So, and it's very uncertain, and it underlines the importance of people.
Well, I suppose it's not
diversified.
it's not just economics turned on its head, but it's markets in general turned on its head. In this moment in time, the world is kind of turned on its head. But that's it for today. Thank you very much for joining us today. We're going to be back with you in the next couple of days. Similar, we just want to keep our finger on the pulse, help you keep your finger on the pulse, understand a bit more what's going on at this moment in time, and when the dust settles, what direction things might go next. But from me, Mark, and Steve, thanks to everybody, and thanks for joining us.
Thanks, Dave. Thanks, everybody.
Thank you.